Welcome to the Explainer. Today we're going to do something a little different. Go ahead and put on your detective hats because we are cracking open a cold case from the stock market. We're doing a full post-mortem on a tech company, a company that doesn't even trade publicly anymore. So what's the point? Our goal is to figure out if it ever really met the super high standards of one of the greatest investors of all time, Warren Buffett. Let's dig in. So the company in question is Maxim Integrated, ticker MXIM. Now, these guys were a huge deal in the semiconductor world, but then, poof, they were bought out by a competitor in a massive deal. So the real mystery for us, looking back, is this. In the years before it was acquired, was Maxim the kind of incredible business that Buffett is always searching for? Was it a true hidden gem? Or was it just another tech stock trading at a, perfectly fine price? Okay, one really important thing before we go any further. You cannot go out and buy stock in Maxim Integrated. It's gone. So this isn't a stock tip, not at all. Think of this as a training exercise. We're using old data to learn a process, a framework that you can take and apply to your own ideas. We're learning how to think like a detective, not just looking at dusty old clues. So here's our game plan. First, we're going to open up the case file and get our toolkit ready. Then, we'll put the business and its management under the microscope. After that, we do what all good detectives do. We follow the money, deep into the financials. And finally, we'll ask about the price of this so-called wonderful company and deliver our verdict. Let's get to it. Every great detective has a go-to set of tools, right? Well, for a Buffett-style investigation, our number one tool is the four-tenet test. This is the exact framework he uses to size up pretty much any investment, and it's exactly what we're going to use to crack the case of Maxim Integrated. So here they are, the four big questions we have to answer. First up, was Maxim a great business that we can actually wrap our heads around? Second, were the folks in charge making smart, rational choices for the real owners, the shareholders? Third, and this is a big one, do the numbers actually back up the story? And last but not least, the million-dollar question, was it on sale? All right, let's start our investigation with the qualitative stuff. The things that don't always show up neatly on a spreadsheet but are absolutely essential for a great business. We're looking for our first major piece of evidence, a durable competitive advantage. And a special term for that advantage is an economic moat. I want you to picture a medieval castle. What protected it from invaders? A big, deep, wide moat filled with water. It was tough to cross. Well, for a company, an economic moat does the same thing. It protects its profits from competitors. The wider that moat, the safer the business. So the big question is, did Maxim have one? And the evidence here is just overwhelming. Yes, it absolutely did. Maxim's moat was built on two powerful things. First, really high switching costs. See, its chips were designed deep inside incredibly complex products. Think cars, factory robots, things like that. Once a customer put a Maxim chip in their design, it was ridiculously expensive, time-consuming, and just plain risky to try and switch to someone else. Second, they had specialized know-how built up over decades. That creates a huge wall that's almost impossible for a new competitor to climb. This, my friends, is a textbook-wide moat. So the business was a fortress, but what about the generals running it? Well, the evidence here points to Maxim's management being highly rational. For years, they consistently gave cash back to shareholders through dividends and buybacks. That's a huge sign they weren't just wasting it on silly projects. And their final move? That tells you everything. Selling the company to Analog Devices was a brilliant play to get the absolute maximum value for their shareholders. That's the ultimate rational decision. A great story is one thing, but a true Buffett-style investment has to have the numbers to prove it. So now it's time to follow the money trail. We're going to dust for prints all over the financial statements and see if they confirm what we suspect about Maxim's quality. And wow, the numbers practically scream quality. Take a look at return on equity. That's how well they turn shareholder money into profits. Buffett likes to see 15 to 20%. Maxim was delivering a stunning 34%. Check. How about gross margins? A consistently high 65%, which tells you they had serious pricing power. They weren't in a race to the bottom on price. Check. And what about debt? Super conservative. A debt to equity of just 0.41 means they were funding their growth with their own profits, not by taking on a ton of risk. Check, check, check. The financial evidence is just rock solid. Okay, let's recap. We've pretty much established it. Maxim Integrated was a wonderful company. It had a wide moat, smart management, and fantastic financials. But this brings us to the last, and let's be honest, often the hardest, part of the whole investigation. What was it actually worth? And even more important, could you get it at a discount? This is where we have to talk about the margin of safety. This idea is the absolute cornerstone of value investing. It just means you only buy something when its market price is way below what you think it's really truly worth. That gap, that discount, that's your protection. It's your cushion in case you're wrong about something, or if you just get unlucky. And this is where our case hits a dead end. Looking back, a reasonable estimate for Maxim's real value was somewhere between $100 and $115 a share. But the market price right before it was bought? About $102. You can see the problem, right? There was basically no discount. The market wasn't dumb. It knew Maxim was a great company, and it priced it that way. For a new investor, there was just no margin of safety to be found. So with all the evidence laid out, the business quality, the management, the rock-solid financials, and finally, the price, it's time to close this case file and deliver our final verdict. And the verdict is crystal clear. It fits perfectly into one of Warren Buffett's most famous sayings. Maxim Integrated was, without a shadow of a doubt, a wonderful company at a fair price. It passed those first 3 tests with flying colors, but it stumbled on that fourth and final hurdle, the price. So what does that verdict actually mean? Well, it's pretty simple. If you already owned Maxim stock, it was an easy hold. I mean, why sell a fantastic business? But if you were a new investor looking for a bargain, the price was just too steep to make it a screaming buy. The quality was right there for everyone to see, but the opportunity to get it on the cheap just wasn't there. This whole investigation really just brings this piece of timeless wisdom from Buffett to life, doesn't it? Maxim Integrated is the poster child for a wonderful company at a fair price. For investors who care more about quality than anything else, it was a great thing to own. But for the deep value hunters looking for a 50-cent dollar, it just wasn't the right fit. And that kind of leaves us with one last question to chew on, a question for you. Take a look at your own portfolio. How many truly wonderful companies do you own? And here's the kicker. Did you get to buy them with the margin of safety? At a wonderful price? Because it's that combination of both, great business and great price, that really creates those life-changing returns.